Hey everyone, I hope you're all doing well out there. This is your May market review. For those of you that are newer to watching these videos, my name is Dan Westfall. I'm a certified financial planner. I put these videos out each month to give my clients the straightforward information about what's going on in the stock market and the economy and ultimately how that affects their money. So for this past month of May, stocks were positive for the month. The monthly returns for the major indexes here, I have a chart that I'll throw up there. The NASDAQ was up, leading the way, followed by the Russell 2000, then there's the S&P 500, and then there's the Dow, the indexes for some of your international type of indexes like the EFA and the emerging markets index were all a little bit below those of the S&P and the NASDAQ, which the NASDAQ is predominantly technology-based companies, so which technology had a very big rebound from the drop-off in April. So that was a good sign, seeing that the markets rebounded and everything was looking positive for the month. The sector, next chart I have here just kind of shows you an update on the sectors. So for those of you that haven't watched these before, I like using a lot of visuals and charts to go over updates and talk about financial concepts, just because I think that visuals help help people grasp financial concepts a lot better than just words and basic sort of conversation around it. So this chart is showing the major sectors in the S&P 500 and the rates of return and fluctuations throughout the month. The sector that led the way for this past month was actually utilities, followed by technology, communication services, real estate, so on and so forth. So utilities, that was one big mover within there, was mainly because of really an AI or a technology related market movement, which revolves around artificial intelligence or AI. A number of utility companies really took off in the month of May with the idea that because of AI, companies were going to have to use more energy from these companies to help with the production and whatever they're doing with AI. So that was one of the big movers there for the month. So next chart I have here, this just shows actually. This is the 1 year returns of all of the sectors. You can see communication services leading the way, followed by financials, industrials, technology. So, what I try to do, for those of you that don't know, if you have an IRA with me, I use what I call a sector rotation strategy, where I try to eliminate certain sectors and then overweight other sectors to help out with the growth of the overall stock portion of the portfolio. So certain sectors that I haven't had in there over the last year, utilities, which obviously this past month would have been nice to have utilities in there, but I haven't had utilities in there for well over a year, which utilities has lagged overall. I also haven't had consumer staples or defensive staples or real estate in there at all, which those are all the bottom tier over the last 12 months. I haven't had those in that portfolio for well over a year and a half now. So that the idea behind that is that then I can then use that money to then put into areas like technology or communication services to help with the growth of the portfolio versus the basic index. So, just kind of bringing that chart up though. So another chart I had here, I thought I came across this, and it's a nice little pretty visual, and this just shows the returns of asset classes. Both year to date, 1 month, 3 months, 6 month, 1 year, 3 year, 5 year, and it shows them broken down in comparison to the S&P 500 is in there, which that's your main stock market index. It breaks it down into growth, value. There's international stocks in there. There's bonds in there. So one of the trends you can see if you're just looking at the colors of the chart is that growth has been at the top for pretty much the entire time. So whether we're looking at a 1 year, 3, 5, 10 year time frame, US based growth stocks, which predominantly those are like technology, communication services, those types of companies that are held inside of there are predominantly in the more growth oriented segment of the stock market versus value-oriented companies tend to be more like energy or financials, or healthcare is more in a value-oriented segment. So we can see the difference. Obviously, U.S. value has done well. It's been in the top tier the majority of the time too, but hasn't done as well as growth. But I like the chart though because it really depicts a lot of the asset classes, like bonds specifically. So that would be like your U.S. Treasury bonds, your aggregate bond index, municipal bonds. All of those have been at the bottom of the bottom tier over the last 10 years, especially over the last 1-3 year time frame, because bonds really haven't done well with interest rates going higher. But even if we go back even further than that, bonds haven't done that well. So one of the reasons that I use the buffer strategies that I've talked with a lot of you about within portfolios, because that still allows us to participate with stocks, but it hedges or buffers a market drop, which really is the goal of having bonds in a portfolio, is to help with not having everything move down if stocks move down. So I thought that was just an interesting chart that I wanted to bring up, because I've talked about it in a number of market reviews over the last few months of the returns of bonds versus stocks out there. So I thought that was an interesting one. One of the most common things, this is kind of going off chart here, but one of the most common things, I'd done investment reviews in May with a lot of my clients up in Pennsylvania. I did all the in-person reviews for those of you that do in-person reviews with me up there. If we didn't get together in May and you want to do a review, I probably would have reached out to send you my calendar to do a Zoom investment review. So if you didn't get that and you want to check your email, because I probably sent it to you, but if you do want to get together and you didn't get that email, just let me know, reach out to me, and we can link up via Zoom here. But one of the most common questions that I got while I was up there, especially because of, I think, timing of the review, and that we aren't getting together again until December, was what's going to happen with elections. And what I told everybody, and I'll share this with you guys there, is elections ultimately, while that's a stalling point for markets, because there's likely to be some sort of pause in market movement, whether there's not going to be a lot of buyers or sellers out there, I would assume, because of not knowing who the next president would be. So I think that September, October is going to be a little bit of a slow within the market, maybe even a drift lower. And then ultimately, regardless of who ends up becoming the president for this next 4 years, I think markets are going to move higher thereafter that. So there's a blog post I created a couple years ago, right before the midterm elections, where I used a lot of information talking about, and you can go on my website under the blogs category and it's titled Politics and Investing. And I used a lot of data going back over the last 100 years, showing the presidencies of, obviously Republicans, Democrats over the time frame, and showing the rates of return in the stock market for those presidencies. And really what stands out there is a number of, only a handful of different presidencies. There's Herbert Hoover's that was negative, but that was because of the Great Depression. FDR's second term as president, that was during the beginning of World War II. You have Richard Nixon's second time frame as president, which was not a negative time frame for the stock market, but it was very close to it, and that was because of high inflation and high interest rates at the time. And then you have to go all the way through George W. Bush, who was the president during both the 9/11 and the dot-com bubble, which was his first presidency, and then he was then also the president for the bulk of the drop for the Great Financial Crisis, which was 2007 through 2009. So it really is less about who's president and more the timing from an economic standpoint of things that are going on. So a lot of the policy that was happening throughout, like Herbert Hoover, for example, he became president and then the Great Depression really started about 9 months later. So not a lot he could do as far as policy at that point, because it was all of the leverage in the 1920s that led up to the Great Depression, and just not having regulation in place that we do today. the inflation time frame of Richard Nixon's presidency, that was more a result of post-World War II and the baby boomer generation and a really good economic time that then led to a significant amount of inflation after that 20-year build-up post-World War II. So that was less about his policy and presidency. Same thing goes for George W. Bush. He wasn't president during the dot-com bubble in the late 1990s, and really there's no policy that Bill Clinton could have put in place to help tamp that down. That was just market timing and a moment happening because of the internet becoming a thing and companies being born because of it. So he was also, obviously 9/11 was a bad economic time frame. We went into recession because of that. The Great Financial Crisis, that was a housing bubble, that there was a lot of different factors that played into that. So not a lot of things that he could have done with policy there either. And the point of that whole blog post is really depicting it. It really doesn't matter what the presidential policies are. It matters more of what the fiscal or monetary policies are for that come down from the Federal Reserve. And right now that's through Chairman Jerome Powell and his committee. So it's way more important what they're doing with controlling monetary policy and interest rates than it is any real policy that they're doing in the White House. So I thought that was just a good something I wanted to point out to you, because I do get a lot of questions about that. Obviously, my best advice would be steer clear of CNN and Fox News, and you're going to live a happier, better life because of it. And your investments are going to do just as well by avoiding all the content that you're soaking in through Fox News and CNN. So that's my aside though. So next chart that I have is going into just some of the economic numbers, talking about inflation, which this can get politicized as well, kind of tying in the politics part to it. So the chart that you're looking at here on the very top shows the rate of inflation. The chart on the bottom shows interest rates. And I use this chart, kind of tying in some of the conversations that I had during my investment reviews in person in mid-May, was that people think that inflation is still really high, and the conservative media would have you think that, when in reality, stats don't lie, that we have dramatically dropped as far as the rate of inflation goes. That is what that means, is that things, not that they're going to go back to the prices that they were in 2019, but the rate of increase isn't increasing as what it was during 2021 and 2022. So, and the reason for that is because of interest rates going up so much. You can see that direct correlation. When the Fed started raising interest rates, inflation started dropping off. And the Federal Reserve has done a great job with their policies of interest rate hikes and their monetary policy of helping lower inflation. They'd like to see inflation closer to 2% for the U.S. core inflation number, but at least it's heading in that trajectory. So that's something that I think is important to note, because inflation directly affects the stock market. If inflation were to all of a sudden tick higher, in any significant way, we're going to see stocks drop off because of it, because likely what would happen is the Federal Reserve is going to then increase interest rates because of that. So, which isn't a good sign for the stock market, because what that does is that constricts the economy to slow the economic growth down, which just means that companies are going to make less money. So I thought that was an important chart to kind of touch on, at least, especially tying in the political part, because I think that inflation has become politicized. This is another random little fun fact, but there was a study done in the 1980s, and this is when this chart doesn't show it here, but I'll pull up a chart here that shows inflation going back over time. In the 1980s, early 1980s, inflation was peaking in the early 1980s. But when people were asked in, I think it was 1988 or 1987, something like that, on what their feeling was as far as how inflation is inflation still increasing or is it going down? It was across the board a political answer, because if they were Democrat, they felt that inflation was still increasing. If they were Republican, they felt that inflation was decreasing. And at the time, Ronald Reagan was president. So it was definitely very much so a politicized view at that point for whatever reason. But statistically, stats don't lie, inflation in the 80s was dramatically dropping, just as it is right now. So obviously we're on different sides of that. That was a Republican in the office at that point. Now we have a Democrat in the office. But at the end of the day, stats don't lie. There can be arguments of how the statistics are made up, but overall, like the little nitpicky stuff that people want to try to point at really is irrelevant, because the big picture is that the rate of inflation has come down. So last chart that I have to go over here is talking about the housing market, which obviously doesn't have anything to do with portfolios that I'm managing, at least outside of the home construction fund that we use within the stock part. But I thought that this was just a good chart to kind of pull up, showing the rate of interest rates. Current rate for a 30-year is right around 7% right now, and then also then showing the median housing price, which has dramatically slowed down because of interest rates going higher, and that has a direct effect on the housing market that way. So your median home price is in the it looks like 430 range. So I thought that was an interesting chart, though, to kind of tie in everything in different markets that I came across here. So also has the U.S. existing home median sale price, and it has the new houses being sold. So of those new builds that are out there. So that's that I thought that was a good chart, just because obviously for a lot of you that have houses that are homeowners out there, that obviously affects you in that way. If you know of people looking to buy houses, I would tell them to not just to not sit on the sidelines and wait, thinking that interest rates are going to go down. Likely, if interest rates go down, housing prices are going to go up. So that's just the correlation that's going to happen with that. So one way or the other, if they're looking at their monthly payment is going to be increasing. So if they're looking to buy a house, don't sit on it. Talk with a realtor and actively look for something. So that's what I have for you as far as charts this month. If you have questions, don't hesitate to reach out to me. More than happy to answer any questions. Call, text, email. If you have any friends, family members, people you think would be interested in having a conversation with me, love to have a conversation with them, to talk to them more in depth about their investments or their financial life, and have them reach out to me. Call, text, whatever works best. Best thing on my end is if you just do a group, like a three-way text or group text with you, them, and me, where you're introducing us, and then I can kind of take it from there if you're serious about introducing somebody to me. So, but I appreciate you all taking the time to check me out. Until next time.